Hello, everyone, and welcome to the next panel, What's Going On with Money Right Now and Why It Matters. I'm Laura Brady. I'll be the moderator today for the panel, and I'm pleased to introduce our panelists, Caitlin Long, Norma Chu, and Lyn Alden. So really, I think we'll kick off the panel here, just really acknowledging the confusion around some of the financial news, particularly around Bitcoin. If you've been watching Bitcoin in the headlines lately and feeling a little bit of whiplash, I think we could all agree that you're not alone. In the past month alone, the price has swung from 70,000 to 60,000, and today it's actually above 70,000 again. So the headlines have been Bitcoin crashes, almost immediately followed by Bitcoin surges. So it's genuinely hard to really know what to make of Bitcoin. It's no surprise Bitcoin had a brutal February. It's down significantly this year, putting it on pace for one of the worst monthly performances since June of 22. Are the reasons straightforward? Are investors nervous about Trump's tariff policies, rising geopolitical tensions, the war in the Middle East? So they're moving money out of riskier assets like Bitcoin and into safer ones like gold. Let's take a deeper dive into all of these. And so, Caitlin, I'm going to kick it off with asking you the first question here. And how should the audience be thinking about the volatility of Bitcoin in the last month? And really, as it pertains to where are we right now with inflation, the cost of living, interest rates, debt levels?
Thank you. Thanks for hosting this. Hey, all you beautiful ladies out there. It's a pleasure and an honor to be on this panel. And I would say that Bitcoin's volatility is a feature, not a bug, especially for long-term holders. I always fall back to what Nick Szabo said in Miami almost exactly 5 years ago at the 2021 Bitcoin conference, that liquidity is not a must-have, it's a nice-to-have. That wide bid offer spreads when you need to sell your Bitcoin is not the end of the world, and that bringing all these Wall Street folks in, as so many folks cheered, I was concerned it was a double-edged sword having come from Wall Street. And I think it sure seems like there's an awful lot of truth to the craziness of some of the market manipulations, the 10 a.m. slam down that was happening almost every day. Also, the weekend, slams that were happening almost every weekend. These things were clear patterns, and they're not happening anymore, in part because they're called out, and lo and behold, Bitcoin's rallying. So I'm interested to hear what my co-panelists have to answer on that question as well, Laura. Thank you.
Norma or Lyn, any further comments?
Sure, just 1 second. Can you guys hear me?
Yes.
Okay, great. Well, maybe I'll start with saying, I used to run equity research at HSBC Private Bank in Hong Kong. And now I run my own food business with a Bitcoin treasury. So I've kind of seen this volatility on both sides. I've seen it on, Boulevard Terminal. Now I'm seeing it on my P&L. And I think the way I make sense of this in terms of Bitcoin, and I think of it in like 3 different layers. The first one is like, the signal layer, where we have the 4-year supply halvings, fixed supply, and the adoption curve. That kind of is slow and is structural. And then we have like the market structure layer with the ETF flows, leverage, how much supply sits in long-term holders versus short-term traders and derivatives positioning and all that stuff. Third is, the noise layer, which is the media headlines, right? The narratives and social media. I think if you were to judge Bitcoin only on the noise layer, then you'll probably never own enough for it to matter. But I think, for us at the company, when we run it in the treasury sense, we really anchor all the decisions on the signal layer and the market structure layer. So, we kind of observe the noise, but we don't let it dictate what we do and how we, purchase and run the treasury strategy. So I think my advice would be like, if volatility makes you lose sleep at night, the problem is probably not Bitcoin itself. It's probably the position or the sizing that is wrong with your appetite. So the solution is not to ignore Bitcoin, but it's probably to size it within your portfolio so you can actually hold it through, the crazy headlines that we see from a day-to-day basis.
I would add to those 2 points by just saying that fundamentally speaking, in order for Bitcoin to grow large from a very tiny starting base of literally zero, by definition, it needs upward volatility. And anytime you have upward volatility, it's going to attract leverage at some points, and it's going to attract euphoria, and it's going to get over its skis, and people are going to own it for the wrong reasons or in the wrong size. And that inevitably leads to periods of washout and downward volatility. It'd be great to have tremendous upward volatility without any sort of downward volatility, but it's just not how markets work. It's just to get it's basically a fundamental human nature issue. And so Bitcoin is something like 17 years now into its monetization path. We might all have different views of how big it's going to get or how long it's going to take to get there. But it needs that upward volatility along the way. And so there's no path here. There's no world where it wouldn't have downside volatility as well. And so I agree that position sizing is important. Having the right expectations for it is important, or at least kind of expectations that are conservative and that are kind of expecting that volatility. And then that's what allows you to treat that volatility more as a feature and less so as a bug that can disrupt your goals with it.
No, thanks for that, Lynn. That's great. And if we think about just how our current system works at a high level, banks create money through loans. The Fed controls the cost and availability of that money through interest rates and liquidity tools. And the whole system runs on trust, which is both its greatest strength and could be its greatest vulnerability. So as we head into the next question here, Norma, maybe I'll target you for this one. Can you walk us through how our current system works across central banks, money creation, and liquidity?
Lynn will be the expert on this question, but I'll try to describe the system.
We can have Lynn kick it off if you'd rather.
Sure, yeah, let's do it. Now I'll add my take to it.
Sure. Basically, right at the current system, we have the central bank in any given country running the foundational ledger, the number of base units in the system. They have the ability to buy assets by creating new base units, and they also have the ability, which they use more rarely, to destroy base units. And on top of that, we have this fractional reserve banking system where banks, they take in customer deposits and they use most of those to make fractional reserve loans, and they hold some small percentage, and that percentage varies over time in those base units. And on top of that, we even have another layer, shadow banking and other types of arrangements. So we really have two, three, sometimes even more layers. When you go international, because the dollar is the primary global reserve currency, we also have euro dollars, which are just offshore dollars, whether in Europe or elsewhere. And these are basically fractional reserve built on a fractional reserve, much like shadow banking, but internationally. And so you have a whole bunch of nested ledgers going back to what is basically a essentially a spreadsheet at the central bank. Now, if you go back long enough in history, that used to be, they would hold gold as some percentage of their ledger. They no longer do that in any sort of appreciable amount. I mean, different countries have sovereign gold reserves, but they don't really directly back their currencies with it anymore. And so that's currently how the system runs with that just nested ledger approach. The various liquidity facilities that exist are mostly about making those base monetary units more fungible or more kind of interchangeable with non-monetary assets, with the primary one being treasury bonds. And so, for example, the Federal Reserve has these standing facilities that are kind of at the ready. If some entity has too many treasuries and they need dollars, they can, lend the treasuries out and get cash temporarily, or in some cases, like after COVID, when there were a lot of stimulus, if they have excess cash, which is like a funny problem to have, but some entities do have it, they can stick it with the Fed and then get treasuries. So they have these kind of multi-directional liquidity facilities that try to put out kind of near-term liquidity fires. And then they have that longer approach where they can literally just print new base units and tweak the size of the system over time.
Lynn, you've got a lot of fans in the chat talking about how great your book is. I would echo that sentiment. Anyone
Thank
who
you.
wants to learn the details, that is truly a magnificent magnum opus that Lynn wrote, and I would highly recommend that folks read it if you haven't yet.
I appreciate that.
Norma, did you have any comments to add, or
It's hard to top what Lynn said, but I think I guess I'll share my perspective, and I in this particular topic, I think I'll put back on my equity research hat from many years ago. I think he's how I would frame, the core issue, and I think in the existing system, almost all money is somebody else's liability. Like a deposit is the bank's liability. The bank depends on the central bank. Governments depend on bond markets, and in every crisis, somebody has to decide, who gets saved and who gets diluted. But Bitcoin in this within the system, Bitcoin is probably the first major monetary asset that a company like the one that I have can own that is nobody else's liability. And I think that's what attracts Bitcoin, me to Bitcoin as a treasury reserve asset. And that doesn't, make it risk free, but it changes the nature of the risk. So instead of, political or counterparty risk, we now have, price risk and technology risk.
No, that's great. Thank you for sharing that. And so, what does this mean for individuals? Purchasing power of your money erodes over time. How should we be thinking about what inflation actually does to your retirement? So, for example, if you retire with $1 million and inflation averages just 3% annually, in 20 years, that $1 million will only have the purchasing power of about 550,000 in today's terms. You haven't lost any money on paper, but almost half of your real wealth has quietly vanished. So, this is almost like the silent tax that no one talks about in terms of retirement. What are your guys' thoughts here on how people should be thinking about retirement?
Well, it forces folks to take risk. And I think there are a lot of studies about differences between men and women in risk tolerance. And women tend to, especially early in their careers, as they start to earn money and have savings, they tend to be too conservative. But part of the reason is that the monetary system is forcing folks to take risk in order to outperform that 2% debasement target that is explicit every year in most central banks targeting. And that forces folks out on the risk curve. And those who don't have risk tolerance, and again, there is a gender difference in this, have a tendency not to participate in that compounding.
I think
Any,
one way to,
Go ahead.
structurally to think about it is in most assets, not all, but most assets, there's an ongoing dilution that happens. Um, that even happens with gold. There's something like a 1.5% annual estimated supply growth rate of refined gold in the world as kind of a baseline of what money used to be. In the current, fiat currency system, a typical developed market might have 6 to 8% long-term annual supply growth of that currency. Many emerging markets are in the double digits, sometimes unfortunately even higher. And so there's this ongoing variable dilution rate that happens. Same thing with bonds. I mean, they're basically, just layers on top of fiat currency. Equities, it depends. They can actually sometimes be deflationary. They can buy back their own shares. But one way to think about it, regardless of what you're owning or saving or investing in, is to kind of be mindful of what that dilution rate is, if there is one. Because that's the part that often goes invisible, kind of by design. That if you're earning, say, 3% in your savings, that can seem great. It seems like you're earning 3% on your money. But if that money supply is growing by an average of, say, 7% per year, and you're getting 3% interest, and then ironically, you're often, depending on the account, you're getting taxed on that interest. Your percentage of the ledger is getting diluted over time. And that's where that risk problem comes into play that Caitlin mentioned, where it seems like you're being prudent, but you're actually saving in melting ice cubes, which then forces you into scarcer or more growing assets, but they tend to have volatility attached to them. Obviously, Bitcoin's attractive because the long-term dilution rate is zero, potentially even negative if some people lose their coins over time. Um, and it's not the only asset that has that. There are equities that have multi-year, multi-decade streaks of share reduction. But it's the one that's got monetary properties. So that's kind of pre-programmed. It's not a governance decision that changes over time based on the prospects of a company. So I would just kind of, I think anytime you save and invest, whether it's Bitcoin, whether it's dollars, whether it's gold, whether it's equities, bonds, even real estate, which changes in supply over time, always be mindful of the question: at roughly what rate am I getting diluted in the investment that I own, offset by whatever if there is interest, what does that compare to the dilution rate? If there's not interest, hopefully it's an asset that's not really diluting at a substantial pace.
I love the chat,
Yeah.
by the way. You picked a great chat, a great platform, because your audience is actively participating. There's quite a debate over whether women have higher risk tolerance than men or not. So, sorry, Norma, go ahead.
No, I was going to add, like, I think one of the biggest blind spots in retirement planning a lot of times is that we think in currency targets and instead of like purchasing power targets. We say to ourselves, like, I want $1 million when I retire, right? But instead, I think we should be thinking like, I want when I retire to have 30 more years of amazing food, live in a nice house, still have good health care, and have nice trips at the today's quality, right? Maintaining the same lifestyle or even better lifestyle. So I think that's the first blind spot that we should really just think about retirement planning or targets in currency terms. And our own everybody, male, female, our own personal balance sheets is like our own little family treasury. And so it really deserves a very deliberate strategy. And thinking about, savings and planning ahead into buckets. So, we started this panel talking about volatility in Bitcoin, and people feel like, all these big drawdowns are a huge risk. I think the real risk is that your money might lose 30% in its purchasing power over a decade, while you still assume that, our current world exists the same way 30 years later. So I think that's a different perspective sometimes.
I saw Elaine talk about how over time, women have a better performance rate. There have indeed been studies that women have a better performance rate because we don't trade as much. Men have generally more of a willingness to take short-term risk. And that's why in the portfolio management world, there have been studies that women have less of a tendency to sort of chase markets. And in Bitcoin, as volatile as it can be, that is one of the ways you can lose money, unfortunately. A lot of people got stopped out who had borrowed against their Bitcoin and were willing to take more risk than, in retrospect, they should have in some of these most recent market swoons. So I recognize I opened quite a debate here, and I recognize that there's data on both sides. Good debate.
So as we think about, where sort of Bitcoin fits into this picture of retirement and people trying to save, money, given everything we've covered, Bitcoin isn't just a speculative tech asset. When you understand the financial system, Bitcoin starts to look like a direct response to it. So let's kind of dive into a couple more questions here. Hedge versus speculation. The honest answer is that Bitcoin behaves like a long-term inflation hedge, but a short-term speculative asset. You have to be willing to hold through brutal drawdowns to capture the long-term benefit. So is this a long-term signal versus short-term noise? And is it a psychological signal? Who wants to take this one?
I think I would look at it from two different lenses, right? I think if we look at Bitcoin, the asset itself is built like a hedge, right? With the fixed supply, no central issuer, no bailout mechanism. It's kind of monetary policy is encoded. And it changes very slowly, if at all. But then the other lens is like Bitcoin, the market often behaves like a speculation. So there's leverage options, all types of derivatives around it, and also traders reacting to all the narratives that's shifting every day. So I think that's where the speculation feeling, the casino feeling comes in, which is like Bitcoin, the market versus Bitcoin, the asset itself.
I agree. And kind of the interesting thing about it is that as a asset that you are able to self custody, it gives you risk off properties in many ways. Most assets that you can invest in have some degree of counterparty risk, potentially in addition to the price risk or other kind of fundamental risks they have. And along with basically precious metals and a few other kind of liquid assets, Bitcoin is one of the few things that you can hold yourself outside of, an account, outside of the traditional system, that gives you basically protection against a lot of things. And that can matter less sometimes in developed countries where you feel very stable. It can matter a lot more in extreme environments, whether it's unusual times in developed countries or more frequently, unfortunately, in many other countries around the world. And it allows you, unlike precious metals, allows you to, beam those assets to someone else over the internet, and you can audit it in roughly real time. And those are all kind of naturally risk-off properties. But because Bitcoin is a 17-year-old asset, it's still relatively small in the grand scheme of all the assets that are out there. It's still not widely held in the world compared to other types of assets. Um, and so it still has a pretty high degree of uncertainty around it. It's treated that way in terms of price risk. For a long part of its history, it was unclear how governments were going to react to it. Sometimes governments would flip flop their positions on how to treat it. Sometimes it'd be discouraged. Sometimes it'd be more allowed and treated kind of like other assets. How banks would function with it. In addition to just the ongoing technical questions around it and people's evolving understanding of it. There's many other assets where people grow up with those assets already existing, whereas Bitcoin's a young enough asset that most people had a conception of assets, and then Bitcoin shows up, so they have to learn what Bitcoin is rather than just it always being there, like many other assets. And so that adds a lot of price volatility to it. That adds a lot of risk and kind of headline risk to it, even though, and so it's treated in a portfolio for the most part like a risk on asset still, even though it does give the user, apart from that kind of price volatility, it does give the user risk off properties.
Yeah, no, that's great, guys. So what should we be paying attention to moving forward? Signals that matter. What is worth learning about? The game isn't to predict what Bitcoin is going to do next. I think we all have lost at that game, but the game is to understand what Bitcoin is, own an amount you can hold through chaos, and let time do the work. So I'd love for each of you to kind of answer this question. What should we be paying attention to going forward?
There is a fundamental cycle in Bitcoin which pertains to the miners cycle. And I've been one that has subscribed to the 4-year cycle history. There's a lot that's been written about this that's available online if that concept is new to you. And there's been a debate about whether the 4-year cycle still exists in Bitcoin. It's technically not 4 years. It's 210,000 blocks, and at an average 10-minute block timing. And that is the most, the fundamental, if you step back, what's really going on is that the halving of the block reward every 210,000 blocks is a fundamental feature of Bitcoin that causes miners that are marginally profitable before the halving to become unprofitable after it. And therefore, we do see typically a decline in the hash rate in the Bitcoin network right after a halving. However, and by the way, that is fundamental, and that has historically been a cyclical trend in Bitcoin. And we are in the bear market cycle of the 4-year trend. So there's still a debate over whether that 4-year trend is as pronounced. And there's on the flip side, there's an argument for why it's becoming less pronounced, because at each halving, the block reward gets cut in half. And we're asymptotically getting closer and closer to the 21 million Bitcoin already having been mined. And so each epoch of Bitcoin's history becomes less impactful on the denominator as we go every 4 years. So all that said, I still think, having been on the board of a mining company, Cipher Mining, now Cipher Digital, which has pivoted towards AI data centers and less so Bitcoin mining, recently announced that it's not going to stay in Bitcoin mining. I've watched that from the inside of a Bitcoin miner, and it's very real. We definitely see that after the halvings, that the marginally profitable miners end up shutting down, typically liquidating, and therefore, if they have Bitcoin in their inventory, selling it. And that is not nothing, although it is true that it's becoming in each epoch less as a percentage of the total outstanding.
I'll go next. So I'll watch for probably two things. The first thing is ownership. Who's owning Bitcoin. I think over time you can track whether Bitcoins are moving from short-term traders to long-term holders. including corporate treasuries and institution. I think that tells you whether the base of the owners is getting stronger and more patient versus weaker and more speculative. And so I think as more companies and also long-term entities accumulate Bitcoin, the character of the asset could change over time. Second, I would look for is probably the amount of leverage, how much debt and derivatives sit on top of Bitcoin. I mean, if you look at all major drawdowns in Bitcoin and also in traditional markets, having excess leverage is usually like the accelerator. So I would pay attention to that. And recently, since we've been running the treasury, some of the signals that I get in the market is like when we get to when we see like super creative products or derivative products built on top of Bitcoin, like that offers you too good to be true yield. Usually for me, that's like, signaling some kind of frothiness in the market. So that will be a warning signal for me. But, that's kind of, how we look at it when we run our Bitcoin strategy. I watch for who's owning the coin and and how much leverage sits on top of it. But I think for individuals, it doesn't really, it can be also simplify this to have some kind of, I guess, framework, right? When you think about how to add Bitcoin, or if you're considering adding Bitcoin to your overall portfolio, don't over leverage, don't over concentrate your position, and also don't overreact to a lot of the headlines that we see.
Yeah, a lot of the things I look for are the same things that were mentioned. I think on top of that, I look for other signs of euphoria or kind of depression in the space because they can be kind of counter signals. And there's no perfect metric out there. One of them is basically you can kind of monitor partially on chain, not always because not everything is on chain, but you can partially monitor older coins kind of rotating over time. So there are people that bought 5 years ago, 10 years ago, 15 years ago or more, and when Bitcoin goes up tremendously, Bitcoin went from generally a small percentage of their net worth to a very large percentage of their net worth. Many people have started families or otherwise want to increase their consumption. So there's a multitude of reasons why they are selling some percentage of their coins. And they generally sell into strength of a new cycle. Bitcoin's hitting just major highs and it's very liquid, and they're up a ton, and they're generally selling as new buyers are coming in, learning about the network. And so often you'll see headlines like, strategy of we buying so many coins, and the price will be kind of flat. And people say, well, why isn't the price going up? And it's because there are a lot of people selling as well. So I kind of look for the dynamics of that. How much selling pressure is there? How many older coins are being unlocked? This again, that's not always a bad thing, just because any growing asset, starts off kind of concentrated, held, early adopters, and then over time, as they kind of this happens with startups as well. You'll have a handful of early investors own a big percentage of a company. As the company becomes very large and liquid, you get selling from those earlier holders, the founders, and things like that. And even though Bitcoin's not an equity, it still has that similar kind of distribution effect, much like a startup growing from zero into the trillions of dollars. And so I kind of watch those coins over time rotate and broaden, and that could tell you something about the cycle. And the other big thing I look for, in addition to this typical kind of like overbought or oversold status, is things like market value compared to on-chain cost basis, or measures like that, to basically say, as the price gone up a lot more than kind of the average time that the last coins on average moved on chain, because that when that gets very high, that's kind of a sign of maybe near-term euphoria, near-term kind of strong momentum has happened to the upside, which tends to be a little bit challenging for forward risk. And so, generally speaking, when uh, everyone on X is talking about Bitcoin and the price is rocketing, that's when it pays to be a little bit cautious and always kind of think of the downside. And then the alternative is true is if you're getting kind of made fun of for ever having owned Bitcoin, it's down a ton, the sentiment's very negative. I find those more interesting times. And I think that's kind of the overlay that I use on top of just dollar cost averaging in, paying attention to those really long-term fundamentals, and asking pretty basic questions like, is Bitcoin getting easier to use over time? Is there more that I can do with my Bitcoin over time? That's basically the fundamental health of the network. What is the developer ecosystem like? Are there new and better wallets out there, or newer, better ways to move around Bitcoin or do things with your Bitcoin, keep your Bitcoin secure? All of those, software, hardware products improving over time or not, and at what pace.
No, that's great. Thank you both. And so I'm going to actually pivot here and switch to some of the Q&A. We've got some great questions coming in. And just a reminder to the audience, if you'd like to ask a question, to just click on the Q&A button and you can type your question in there. But, obviously, AI has been all over the news with Anthropic and the government and things going on there. And so this question is pretty timely and relevant. What about Bitcoin as a hedge against the potential deflationary impact of AI with likely abundance and disruption of business models? Is Bitcoin scarcity a great hedge for this environment?
I can tackle that. Do you want to tackle that, Norma? Do you want me to?
Go ahead, Lynn.
So I think basically whenever we have a period of tech deflation, when you own things that are not disrupted by the tech deflation, that's generally a good thing. So for example, during the 90s, 80s, 90s, and 2000s, we had automation of manufacturing really kind of pick up steam, and also offshoring. And that combination is very powerful. It really reduced the cost of manufactured goods, while it didn't really do a lot to reduce the cost of services, hospital services, education services, insurance, and other types of kind of service things. So that deflation was more concentrated. With AI, it looks like we're going to see probably quite a bit of deflation in more of these white collar types of services. Those things get a lot more abundant. It can be very disruptive if it comes online quickly, as it has been. But it doesn't really do a lot. It can't make more Bitcoin. It doesn't really do a lot for how much gold we mine out of the ground. It doesn't make it radically easier to build a house, at least until many years in the future, maybe have a bunch of robots that can make that cheaper. But in kind of an investable time horizon, it doesn't really affect some of these scarcer physical things. And so when you own those types of assets, as other things get cheaper and get disrupted and have tech deflation, those scarcer assets can do quite well, especially because the way that the fiat currency is designed, it really has to grow in supply, or it runs into issues. It's kind of how it's kind of built at its bedrock. I mean, basically, all these loans come into existence on fractional reserve. They all have to be paid back with interest, and so we see this kind of gradually ever growing system. And generally speaking, the more tech deflation there is, um, the more we generally see central banks try to maintain their positive inflation target. So technology is always making things cheaper. Central banks always want prices to go up. And so the more tech deflation there is, the more they are willing to encourage more lending, or outright print money. And that makes the value or the purchasing power of kind of these truly scarce assets that are leading in their categories, whether it's the best stocks, in some cases, precious metals, Bitcoin, high quality real estate, even fine art. These things that are not being rapidly reproduced are the things you generally want to hold in those types of environments.
Awesome. Another question here from the audience. What's the difference between Bitcoin and a BTC ETF? Pros and cons are both equally as a good of an investment. I know a lot of the wirehouses and advisors actually only allow Bitcoin ETFs at the moment as well. So just taking that into consideration.
I think I'll just start with, I think ETFs is probably, it gives a lot of mass or general investor easier access to get Bitcoin exposure, just because you can buy and trade out of it and out of it fairly easy, just like your portfolio. I think that's the biggest difference for individual investors thinking about building Bitcoin or adding Bitcoin to their portfolio.
Yeah, I mean, there's pros and cons. I think, and some people obviously, wonder if ETFs were good for Bitcoin. I think it's inevitable. Anytime an asset becomes worth trillions of dollars and is liquid, it's going to have ETFs made on top of it. It's not that Bitcoin changed to have ETFs. It's that the fiat system decided to make ETFs, and put Bitcoin in them. That's just an inevitable path of monetization. Um, some of the downsides of ETFs is that you can't use Bitcoin for its fundamental properties. You can't self-custody it. You can't permissionally send it to others. You can't, travel around the world and still have access to it. You can't split it into a multi-sig and things like that, and kind of have all the different attributes. But there are millions and millions of people that have brokerage accounts. There's kind of a lot of walled garden capital. And so, as Norma pointed out, it makes it easier to buy Bitcoin, especially for those pools of capital that are already in that ecosystem. It allows it to be purchased more easily in retirement accounts. Depending on what you plan on doing with your Bitcoin, if anything, it can give you some security features in the sense that unlike an exchange account, you can't have coins like unauthorized sent away, nearly as easily. You have it in this kind of predefined wrapper. It's not really prone to that type of irreversible transaction that can happen with other types of accounts or hacks. In addition, there always is some self custody risk. It requires having certain. It's not rocket science, but it does take responsibility and a learning curve to be able to self custody coins properly, especially depending on the amounts that you're looking to do that in. And so ETFs, I think, are a low friction way to get price exposure. And then at some point, if someone has price exposure, they might then want to say, well, what can I do with Bitcoin outside of that? Maybe I want to hold some directly as well. So I think both Bitcoin outside of ETFs as well as some Bitcoin in ETFs are helpful to people.
Awesome. Okay, here's one more question. So, with ETF and derivatives expanding the supply of paper Bitcoin through leverage beyond the actual Bitcoin supply and diminishing the price, what assurance can we have about the future BTC price increase? What limits the leverage supply?
Well, the short answer is solvency. Solvency limits it. Basically, anytime someone is making IOUs on top of Bitcoin, they're taking on risk because those liabilities could be called, and they don't have the Bitcoin backing it up. And unlike the fiat currency system, which involves tremendous leverage, the way it's able to get away with tremendous leverage is because whenever that leverage starts being called, they just can print more base units. And they often don't print it in a fair way, but they do print enough to solve that kind of liquidity fire or that leverage fire that's happening. When it comes to something like gold or Bitcoin, if you have more IOUs than you have base units and you get called out, you're just totally at risk of going insolvent. And unlike gold, gold is very difficult to safely transport in a cost-effective way. Bitcoin moves around much faster. The cycles for leverage getting called out tends to move a lot quicker than it does with gold. And so the short answer is that there's no way to prevent paper IOUs and paper Bitcoin from being created on top of real Bitcoin. That's inevitable when you get to an asset that's this large, that this is this tied into the system. There's no path where this doesn't happen to some degree. But what stops it happening endlessly is basically that there's a fixed supply, and that anytime an entity is operating on too much fractional reserve and not managing that properly, they get called out, and that's been happening since, I mean, all the way going back to Mount Gox, with issues they ran into, and pretty much every cycle we see issues of this. And I think that'll unfortunately keep happening, but that does limit how much total leverage can be built on top of it before some of it breaks.
Awesome. Okay. Let's do one final question here. So, is the context of rising geopolitical tensions and a potential shift towards stagflation, what role could Bitcoin play in an investor's portfolio?
So I can hop. Norma, do you want to take that, or do you want me to hop in, or?
Go ahead. I'll add to what you have to say.
So I think, I mean, whenever you have stagflation, one of the key risks is margins. Corporations of all different types have energy inputs, they have labor inputs, they have all sorts of different things. Obviously, different industries can have different risks of stagflation. You can own a foreign equity that just gets taken away from you if your country and that country are having a geopolitical dispute. I mean, there are people that own Russian equities going into the war, and then they don't really have access to those anymore. So there's all these geopolitical risks that can impact either the profitability of companies or even just the ownership, who owns those companies. And so one of the advantages of owning, self-custodial assets, or assets that have no central governance, is that you have resilience against those sort of things. Bitcoin doesn't have a profit margin. It doesn't have, labor costs per se. Obviously, there's a Bitcoin mining, but that has a difficulty adjustment associated with it. So it doesn't have the same types of risks as a corporation, especially as like a corporation that's domiciled in a way that, can face political risks. So I think that whenever you have stagflation, in addition to owning the bottlenecks, I mean, historically in periods of stagflation, if you own commodities, commodity producers, energy producers, that they generally do pretty well. But also owning hard monies historically does well. And when you go back far enough, the track record we have to look at is, gold and other precious metals. And then more recently, we have Bitcoin as an option. And at the peak moment where central banks are trying to fight inflation, often these harder monies run into frictions. But during the overall period of money supplies growing, and there's frictions in the economy, generally speaking, over a multi-year time frame, these harder monies tend to do well.
Awesome. I think we have time for one more question. So do you guys own other things other than Bitcoin? Stocks, bonds, other coins?
Personally,
Go ahead, Norma.
personally, I own a fair amount of equities, real estate, and also Bitcoin. Yeah, those are the three I have in my portfolio right now. No other coins though.
Yeah, same here. I mean, I've been investing in equities now for something like 20 years. I've been investing in precious metals for a very long time as well. And so equities, some degree precious metals, and then Bitcoin are kind of the primary assets I own. To the extent that I own real estate, I own real estate not as an investment per se, but I own real estate for what I live in. So I have two properties that in different countries. But for the most part, I prefer that kind of equity and Bitcoin focus. I don't own other assets in the other digital assets.
Got it. Okay. Well, thank you both, Lyn and Norma, so much for taking the time and sharing your insights. Once the panel is complete, please select Join Now. That will bring you back onto the main stage for our one-day reflections. And thank you, everyone. Enjoy the rest of your day.
Thank you, Laura. Thank you, Lyn.
Thank you.